Welcome back to the deep dive. Today, we're on a critical mission, really. We're looking straight through the surface column of Tuesday, November 25th, 2025. If you were just watching the tickers, you saw a market that, looked healthy enough. The S&P 500, the SPX, it finished the day flat to modestly positive.
Right. Held those key moving averages.
Exactly. But the institutional positioning, the technicals we're looking at, they tell a completely different story. A story of quiet de-risking and some pretty significant systemic stress. So the real question is, was this genuine accumulation or was it a managed distribution?
It was absolutely the latter. I mean, this was a classic day of internal divergence where the headline indices they lied.
Okay.
While the SPX technically held its ground, up maybe 1/3%, the Nasdaq 100, the NDX, was quietly bleeding out, finished mixed to negative.
And that's a warning sign.
It's a huge warning sign. When the broader market looks stable but your tech leaders are slipping, that is not a sign of confidence. It's a signal of selective profit-taking. Cautious positioning. Institutions are not rushing to deploy capital here.
That divergence is so key. So let's stick with the SPX for a second. If institutions were really that cautious, why did the index sell off? What was holding that floor?
Well, it held because the selling wasn't broad. It wasn't panic-driven. It was very tactical distribution, and it was being met by, passive or systematic buying.
Right.
But the options tape, that's where you see the real intent. SPX options volume was a little muted, sure, but the crucial indicator, the volume put-call ratio, stood firmly at 1.16.
The 1.16 put-call ratio, that is definitively bearish.
Exactly. It means institutional players were buying 116 units of downside protection puts for every 100 units of upside bets or calls.
So much for accumulation.
It completely refutes the idea of aggressive, broad-based accumulation. You had heavy hedging, you had outright short positions, and all of it was just masking the surface price action. We know from flow data earlier this week that large traders were already selling into strength.
Using those little rallies as an exit.
Precisely.
Oh,
an opportunity to lighten up exposure and, take some chips off the table.
So the lack of a major sell-off wasn't buying conviction. It was just managed selling, meeting passive inflows. What about that NDX weakness? Was that just tactical or was there a catalyst?
It was partly catalyst-driven, which just goes to show you the fragility of it all. The tech index saw some really notable distribution, especially in a bellwether name like Nvidia. That followed news that Meta might be investing in Google's AI chips, and that single piece of news created enough uncertainty, a potential shift in the competitive landscape, to trigger sharp selling that the buyers just couldn't absorb.
So the leadership is incredibly sensitive right now. Okay, let's move from the indices to the internal structure of this rally. Because if the selling is managed and the indices are flat, the next question has to be, how healthy is the underlying market? Are we seeing broad participation?
No, absolutely not. This is the textbook definition of concentration risk, which means the rally is just incredibly fragile. We are operating with extremely narrow breadth.
So what does that look like in the data? What's the advanced decline line showing us?
The advanced decline line, which is basically the running tally of stocks going up versus down, has either completely lagged the SPX's recent climb, or, on some measures, it's actually been trending sideways or even slightly down.
Wow. Okay, that's crucial.
It is. It means that while the S&P 500 index shows progress, fewer and fewer individual stocks are actually participating in that move.
So you got the major averages being dragged higher by, 5 or 6 mega cap names, and everything else is just flat or declining.
That's it, and that is a huge systemic vulnerability.
And the volume backs this up.
The volume confirms it. The advanced decline volume readings have been muted. You need to see positive readings consistently above, say, 70% to confirm broad, confident buying. We haven't seen anything close to that.
So if those few bellwethers falter for any reason?
If the handful of stocks providing 80% of the market's returns falter, could be regulation, bad guidance, anything, the other 490 components just don't have the internal strength to hold the market up. The structure just collapses.
That is a stark picture. So let's shift to the forward-looking signals, volatility and liquidity. The spot VIX, the fear gauge, it did ease today. Closed around 19.1, down almost 7%. Doesn't that suggest near-term fears are fading?
On the surface, maybe. But look, 19.1 is still elevated. It's not historical complacency. But more importantly, you have to look past the spot price. You have to look at the VIX term structure, what institutions are actually paying for future risk.
And what's that telling us? What does the term structure reveal about future anxiety?
It reveals a significant persistent anxiety about longer-term tail risk. Even with the spot VIX dropping today, the curve is showing an excess premium of about 1.6 VIX points further out.
Okay. And that's driven by the skew.
It is. That premium is driven by a very steepened SPX skew, which is sitting at, 79th to 95th percentile highs.
Can you break that down for our listeners? What does a steepened skew like that really mean for an investor?
It means institutions are aggressively bidding up the price of far out of the money puts. They're buying protection against a major crash 6 months or so down the road.
So they're less worried about a small correction.
And more worried about a rapid, nonlinear decline. The market feels okay today, but the institutional capital is heavily invested in insuring against a catastrophe later. The backdrop just still feels very unsettled.
If the longer-term structure shows that anxiety, is there any warning hidden at the very front end of that curve?
There is, a very subtle one, but it's potent. We are seeing a slight flattening of the contango curve right at the front month.
Okay, so contango's normal.
Right, future vol is usually priced higher than today's. When that front end flattens, it's signaling a sudden, sharp increase in demand for immediate hedges, the kind the spot VIX hasn't fully registered yet. It's a technical signal that often comes right before an unexpected short-term vol event. The classic calm before the storm.
That's unnerving. But the most fundamental risk isn't just in equity vol, it's in the plumbing of the system itself. Liquidity. We're seeing stress in the repo market. Why should an equity manager care about that?
I would argue this is the most critical systemic risk we're tracking right now. Equity managers have to care about repo stress because it determines funding costs. And critically, it determines the ability of counterparties to use leverage.
So repo stress indicators.
Yeah.
You're looking for rising rates relative to the Fed funds rate.
Exactly. When that spread widens past, say, 25 basis points, it signals a severe liquidity strain in the system.
And when funding costs spike, what happens next?
Institutions that are running on razor-thin collateral margins, they suddenly face liquidation pressure. If they can't fund their positions cheaply overnight, they are forced to sell assets, often their most liquid assets, like equities, regardless of the fundamentals.
And that's all amplified by the holiday.
It's amplified massively. Liquidity is naturally thinning out as we head into Thanksgiving. A stressed repo market plus thin holiday liquidity is, well, it's a recipe for extreme forced price action.
Okay, so with this backdrop of high price tail risk and systemic funding stress, where is the smart money actually moving?
Right.
Where are their footprints showing up away from the public exchanges? I mean, the dark pools.
The dark pools confirm this whole narrative of quiet distribution and defensive rotation. We're seeing two very distinct behaviors. First, persistent, large block buys in defensive sectors.
Utilities, staples.
Exactly. Utilities, consumer staples, some value-oriented industrials. And they're being executed slightly below the market price, which tells you it's patient, strategic accumulation of quality, low-beta assets.
They're slowly building a bunker.
That's a perfect way to put it. At the same time, we're seeing these unusually large block sells in those exact same high-flying mega-cap growth stocks that are holding the index up.
And they're selling into strength?
Textbook distribution into strength. The implication is undeniable. Institutional liquidity is shifting away from aggressive risk-on plays and towards safety and quality.
Let's broaden out for a second and connect this domestic picture to global factors. Our sources pointed to a few unexpected correlations that are really complicating diversification. What's standing out?
The most overlooked one, I think, is the correlation between U.S. stocks and the Japanese 10-year Treasury yield. We've seen a really significant link emerge there.
How so?
The market sell-off last week coincided with a sharp spike in that Japanese yield. And this recent little relief rally, it coincided perfectly with a pullback in that same yield. It just confirms that global yield movements, especially from Japan, are an underestimated driver of U.S. equity performance.
Okay, and for those in riskier assets, what about the relationship between tech and digital assets?
We've seen a renewed, very tight correlation between Bitcoin and the Nasdaq 100. It just reinforces the view that, for now, digital assets are behaving as high beta proxies for tech risk.
So no diversification benefit there if you're long tech.
Very little, which is why our analysis keeps pointing back to precious metals, like gold. They offer real portfolio insurance because their correlation to equities can shift sharply negative during these major systemic stress events.
So let's synthesize all of this. We have narrow breadth, heavy institutional hedging, dark pool distribution, systemic liquidity concerns. How does a portfolio manager take all this in position for tomorrow, for November 26th? What's the playbook here?
The framework really relies on anticipating where forced action will occur. We focus on three pillars. First is liquidity. So beyond just watching repo rates, we identify what we call liquidity pockets.
And what are those?
They're large, uncleared block trays sitting in dark pools. These levels act like price magnets. If the market gets near them, volatility tends to compress for a moment before the price is either, cleared or rejected. They offer really tactical trading points.
And the second pillar is volatility.
Right. And here we move beyond just the spot fix. We are watching for that flattening of the VIX curve, or even worse, an actual inversion. If that curve breaks its normal shape, it's signaling an incoming volatile event that the spot price is misrepresenting.
So that creates an asymmetric opportunity.
A huge asymmetric long volatility opportunity. The price of protection is cheap relative to the potential size of the move. You're betting on the market's complacency breaking and breaking dramatically.
Okay, and the third pillar, which sounds essential when liquidity is thin, is gamma levels. Can you explain the significance of this zero gamma level and why it's so dangerous?
Sure. So gamma dictates how dealers have to hedge their books. We monitor gamma walls, which are these high open interest strikes that resist price moves. But the zero gamma level, that's the tipping point. It's the price level where the market's aggregate gamma shifts from positive to negative. When gamma is positive, dealers buy weakness and sell strength. It dampens volatility.
A stabilizing force. But when it flips negative,
When the price breaks through that zero gamma level, it flips negative. And suddenly, dealers are forced to do the opposite. They have to sell into a decline to rehedge or buy into a rally.
creating a feedback loop.
A powerful feedback loop that just accelerates the move. So if the market drops through zero gamma when liquidity is thin, which is exactly the setup we have now, you get a cascade effect. And that point of forced hedging is where you find the best asymmetric high-velocity opportunities.
This clarifies the mechanics beautifully. So to summarize our deep dive, the market is being held up by just a handful of names. Institutions are heavily hedged, that 1.16 put-call ratio.
And they're systematically moving capital from growth to defensives in the quiet market.
Meanwhile, the core plumbing, the repo market, is signaling acute systemic fragility, making any volatility spike potentially devastating.
The core finding is just that this rally is narrow, it's fragile, and it's being maintained through managed distribution. The headline calm is completely deceptive. Active risk management using those three pillars is paramount right now.
Which brings us to our final thought for you to consider, and it's based directly on that concentration risk we identified. If institutions are confirming this fragility by quietly distributing growth stocks in dark pools, what level of a market correction would actually be required to panic them back into broad participation? And how quickly could that correction happen if the few remaining bellwethers finally falter? Think about that zero gamma level as you watch the charts tomorrow. Thank you for joining us for the deep dive.